Right now you're probably doing one of two things with your spare cash. Either you're putting it into your mortgage and watching your loan balance shrink each month, feeling like you're making solid progress. Or you're buying ETFs, drip-feeding money into the stock market, hoping the long-term growth does the heavy lifting for you. Both feel responsible. Both seem smart on paper. But over the next 10 or 20 years, one of these paths will leave you significantly wealthier than the other. And the gap is bigger than most people realize, because almost nobody sits down and runs the actual numbers across both strategies side by side. Let's start with paying down your mortgage. When you make extra payments toward your home loan, every dollar you put in directly reduces the balance your lender charges interest on. So if your mortgage is $600,000 and you've paid an extra $80,000 toward principal, your lender only charges interest on $520,000. That $80,000 isn't earning you interest in the traditional sense. Instead, it's stopping interest from being charged against you. And here's the part that hooks people. The money you save on mortgage interest is completely tax-free. You don't report it. The IRS doesn't touch it. It's not income. It's simply interest you were never charged. At today's rates, with the average 30-year fixed mortgage sitting around 6.5 to 7%, that extra $80,000 applied to your principal is effectively giving you a guaranteed 6.5 to 7% return that the federal government can't tax. If you're in the 32% federal tax bracket, a 6.5% tax-free return is the equivalent of roughly 9.5% in a fully taxable investment. That's a number that makes a lot of people stop looking for alternatives. No volatility. No risk of loss. No watching your balance drop 15% in a bad quarter. Just a clean, consistent benefit every single month. Now let's talk about what happens when you take that same $80,000 and put it into ETFs instead. Exchange-traded funds give you access to hundreds or even thousands of companies through a single purchase. Funds like VOO track the S&P 500. VTI gives you the entire U.S. market. International options like VXUS spread your money across developed and emerging markets around the world. The U.S. stock market has returned an average of about 10 to 12% per year over the long run, including dividends. Even after you adjust for inflation, long-term real returns on U.S. equities come in around 7 to 8%. Over the past several years, broad market ETFs have delivered somewhere between 9 and 14% per year depending on the fund. So just looking at the raw numbers, ETFs come out ahead. More growth, more compounding, a bigger balance at the end. But here's where it gets more complicated. ETF returns are not guaranteed in any individual year. In 2022, many broad market ETFs fell between 15 and 20%. During the 2008 financial crisis, the S&P 500 dropped over 50%. If you'd invested $80,000 right before that crash, your portfolio could have fallen below $40,000. And while markets eventually recover, that experience changes people. It causes panic selling. It causes hesitation. It makes people abandon their strategy right when they should be holding firm. Meanwhile, the person who kept putting extra payments on their mortgage saved exactly the same amount in interest that month as the month before, regardless of what the market did. That kind of consistency has real psychological value, especially when your mortgage is large and your financial margin is thin. Then there's the tax side. ETF investing in a taxable brokerage account means your dividends are taxed each year as ordinary income or at qualified dividend rates, and your capital gains are taxed when you sell. While the long-term capital gains rate is 0%, 15%, or 20% depending on your income, that tax drag compounds over time and meaningfully reduces your net return compared to the gross numbers. Your mortgage interest savings don't have this problem. The benefit is structural. There's no income being created, no capital gain being triggered, no legislative change that can erode the benefit. The interest simply doesn't get charged, and that's the end of it. So does that make paying down the mortgage the winner? Not so fast. Because here's what happens when you stretch the timeline out and let compounding do its thing. Over 20 years, assuming a conservative average ETF return of 8% per year after fees and accounting for tax, your $80,000 grows to roughly $373,000. That same $80,000 applied to extra mortgage payments on a 6.5% loan saves you about $160,000 in total interest over the life of the loan. That's a difference of more than $200,000 in your favor if you chose ETFs. And the longer you leave it, the wider that gap stretches, because compounding accelerates as the invested balance grows. But the mortgage paydown strategy has something going for it that never shows up in a spreadsheet comparison. When you reduce your mortgage balance faster, sometimes shaving 5 or 7 years off the loan, all the money that was going toward repayments suddenly becomes available. Every dollar of that former monthly payment can now go straight into investments, into retirement accounts, into building wealth without any debt hanging over you. Paying down the mortgage doesn't just save interest. It compresses the entire debt timeline. And everything that happens after the mortgage is gone changes dramatically. There's also a third approach that ties both of these strategies together, and it's something more experienced investors are starting to use. It's called a cash-out refinance strategy combined with investing. Here's how it works. Instead of putting extra cash into the mortgage, you invest that money in ETFs. Separately, if your home has significant equity, some investors use a cash-out refinance to pull equity at a relatively low rate and invest it in income-producing assets. The logic is that if your after-tax investment return is meaningfully higher than your mortgage rate, you're generating positive spread. It's not for everyone and it carries real risk, but for disciplined investors with stable income and high risk tolerance, it can dramatically accelerate wealth building outside of the home. So what's the real answer? If your goal is to maximize total wealth over 15 to 20 years and you can handle the ups and downs of the stock market without making emotional decisions, ETFs will almost certainly leave you better off. But if your cash flow is tight, if your mortgage keeps you up at night, or if a 20% portfolio drop would push you to sell everything and walk away, then aggressively paying down the mortgage is genuinely the smarter move for you right now. The real wealth gets built when you understand how these two tools work together instead of treating them like an either-or decision. Use extra mortgage payments to build safety, to crush the loan faster, and to give yourself breathing room. Use ETFs to build long-term growth outside of the home. And when your financial position is strong enough, explore strategies that let you put your home equity to work in income-producing investments. The most expensive mistake isn't picking the wrong strategy between these two options. It's having $80,000 sitting in a regular checking account earning 2% while your mortgage charges you 6.5% and the stock market returns 10%. If this video opened your eyes to something you hadn't really thought about, do me a favor and hit the like button, subscribe to the channel, and turn on notifications so you don't miss the next one. I'll see you there.